Rollover IRA, or Backdoor Roth IRA. In 2026, these two strategies get confused constantly, and that confusion is expensive. They sound similar, they both involve an IRA, but they solve completely different problems. Worse, doing one carelessly can sabotage the other. In the next few minutes, I'll show you exactly how each one works, where they collide, and how to know which one belongs in your plan. Start here, because this is where most of the confusion lives. A rollover IRA moves money you have already saved, typically a 401k from an old employer, into an IRA so it keeps growing tax-deferred. A backdoor Roth IRA does something entirely different. It gets brand new money into a Roth account when your income is too high to contribute directly. And here is the part most people miss. If you already own a rollover IRA, it can make your backdoor Roth conversion almost entirely taxable. These two are not independent. So what exactly is a rollover IRA? It moves a balance out of an employer plan, a 401k, a 403b, a 457, or the TSP, and into a traditional IRA that you control. Done as a direct trustee-to-trustee transfer, it is not a distribution. No income tax, no 10% penalty, and it does not touch your annual contribution limit. 3 reasons people do it. The tax shelter stays intact, your investment menu opens up from a dozen plan funds to the whole market, and scattered old accounts get consolidated into one place you actually monitor. How you move the money matters as much as whether you move it. A direct rollover goes trustee to trustee. You never touch the funds, nothing is withheld, and there is no time limit. An indirect rollover sends the check to you, and that is where people get hurt. The plan is required to withhold 20% for federal tax, but you must redeposit the full original amount within 60 days. On a $100,000 rollover, you receive $80,000 and still have to replace the missing $20,000 from your own pocket. Miss it, and that shortfall is taxable income, possibly with a 10% penalty on top. Always choose direct. Now the backdoor Roth. It is 3 steps. Step 1. Contribute non-deductible dollars to a traditional IRA. There is no income limit on that step, so anyone with earned income qualifies. Step 2. Convert that balance to a Roth IRA. Conversions have had no income cap since 2010, and that is precisely what makes this work. Step 3. Report it on Form 8606, which records your basis so those dollars are not taxed twice. Why does this door exist at all? Congress removed the income cap on conversions but left it on contributions. The gap between those two rules is the door. So who actually needs the back door? It comes down to your modified adjusted gross income. For 2026, direct Roth contributions phase out starting at $153,000 for single filers and close completely at $168,000. For married couples filing jointly, the range runs from $242,000 to $252,000. Below those numbers, just contribute directly. The back door is unnecessary complexity. Above them, the front door is locked, and the conversion route has no income limit at all. Here is the rule that ruins otherwise good plans, the pro rata rule. You do not get to choose which dollars you convert. On December 31st, the IRS adds up every traditional, SEP, and simple IRA you own and treats them as one single account. Your conversion then pulls a proportional slice of pre-tax and after-tax money. The taxable portion equals your pre-tax balance divided by your total IRA balance. Employer 401k plans, Roth IRAs, and your spouse's IRAs stay out of that formula, which, as you'll see, is exactly the escape hatch. Let's put real numbers on it. A high earner contributes $7,500 after-tax dollars to a traditional IRA and converts it. But she also holds a $142,500 rollover IRA from a former employer. Total IRA balance, $150,000. 95% of that is pre-tax, so 95% of her conversion is taxable. $7,125 of income she never expected, and only $375 lands tax-free. At a 32% marginal rate that is roughly $2,280 in federal tax, plus state, on a move she thought cost nothing. And it repeats every year she does it. This is the intersection of our two strategies. Path A. You left the old 401k in the employer plan, or rolled it into your current one. Your traditional IRA balance is 0 on December 31st, and your conversion is essentially tax-free. Path B. You rolled that old 401k into a rollover IRA years ago, a perfectly sensible move at the time, and now that balance sits inside the pro rata formula, making most of every conversion taxable. Same taxpayer, same contribution, same conversion. The only difference is where the old 401k landed. Here is the fix, and it is genuinely elegant. Because employer plans are excluded from the pro rata formula, you move the pre-tax IRA money into a 401k, a reverse rollover. Step 1. Confirm your plan accepts incoming rollovers, because not all of them do. Step 2. Move only the pre-tax dollars in, keeping any after-tax basis in the IRA. Step 3. Finish before December 31st, since the test is a year-end snapshot, a January transfer does nothing for the prior year. Step 4. Convert and file Form 8606. One trade-off to weigh. A 401k has a narrower investment menu and tighter withdrawal rules. Usually the tax savings win, but not always. Let's line them up directly. Purpose. One preserves money you already saved, the other gets new money into a Roth despite income limits. Source. An old employer plan versus new after-tax dollars from your pocket. Tax at the time of the move. None for a direct rollover, but taxable on any pre-tax amount converted. Dollar cap. Unlimited for a rollover, $7,500 for the backdoor. Key form. 1099-R and 5,498 for one, Form 8,606 every single year for the other. And in retirement, rollover dollars are taxed as ordinary income with required minimum distributions, while Roth dollars come out tax-free with no RMDs at all. So which one is right for you? If you just left a job, start with the rollover question, compare your old plan's fees and fund menu to an IRA, and if a backdoor Roth is anywhere in your future, seriously consider rolling into your new employer's 401k instead. If you earn above the Roth income limit, the backdoor is your route, but check your pre-tax IRA balances first. And if both apply to you, sequence is everything. Clear the pre-tax IRA balances into an employer plan first, then run the backdoor. For most high earners, the honest answer is not either or. It is both, in the right order. 5 mistakes I see repeatedly. 1. Skipping Form 8606, which leaves the IRS with no record of your basis, so those dollars get taxed a second time on withdrawal. 2. Forgetting a SEP or simple IRA. Self-employed clients overlook these constantly, and they count in the formula just like any other. 3. Letting the contribution sit and grow, because earnings between contribution and conversion are taxable. 4. Taking the check yourself. And 5. Trying to fix it in January. The pro rata snapshot is December 31st. Every one of these is preventable with a 5-minute review before year-end. Dates decide outcomes here, so mark these. The reverse rollover window is open all year, but allows several weeks for processing. Plan sponsors are not fast. December 31st, 2026 is the hard one. Conversions must be complete and IRA balances must be exactly where you want them, and there is no extension. April 15, 2027 is your contribution deadline for the 2026 tax year. Note the mismatch, because the contribution can be late while the conversion cannot. And remember, only one indirect IRA to IRA rollover per rolling 12 months, across all your IRAs combined. So, the bottom line. First, these two strategies solve different problems. A rollover IRA protects what you have already accumulated. A backdoor Roth builds tax-free money you could not otherwise contribute. Second, the pro rata rule is the whole game. Your existing pre-tax IRA balance decides whether a conversion costs you nothing or costs you thousands, so check it before you act. Third, order and timing beat cleverness. Clear the balances, convert, file the 8606, and do it before December 31st. Run the numbers before you move the money, not after the 1099-R shows up. If you are not sure which one fits your situation, that is exactly the conversation to have before year-end, not in April. At Shore Financial and Tax Services, we review your IRA balances, model the pro rata impact in real dollars, and sequence the moves so the conversion actually lands tax-free. Call us at 900-8955-0696, email contact@suryapatia.com, or visit suryapatia.com. If this was useful, subscribe for more practical tax planning. This video is general education, not individualized advice. Talk to a professional about your own facts.